1. Start with energy, explain with authority, highlight with emphasis, and with warmth. Current market price. Opendoor Technologies Inc., ticker symbol OPEN, is trading at $7.15. $7.15 as of the market close on Friday, December 5, 2025. It was a brutal session for the bulls, with the stock sliding 43 cents, representing a heavy decline of 5.67%, minus 5.67% intraday. While the after-hours market has shown a faint pulse, ticking up 2 cents to $7.17, do not let that minor flicker distract you from the carnage on the daily chart. We are looking at a stock that is being aggressively repriced by a market that is losing patience with the turnaround narrative. The tape is telling a story of capitulation, and if you are holding this bag, you need to understand exactly why the floor is falling out right now. The expectation for Opendoor has always been seductive. It was supposed to be the Amazon of real estate, the friction-free algorithmic market maker that would delete the headaches of buying and selling a home. Investors expected a seamless, tech-first platform that would compound value regardless of interest rates. The reality is that Opendoor is currently fighting for its life in a housing market that is arguably more frozen and dysfunctional than it was during the crash of 2008. The company is no longer trading on the promise of disruption. It is trading on the terrifying math of survival. The reality is that Opendoor is trapped in a pincer movement. On one side, you have a housing market where volumes have evaporated due to 7% mortgage rates. And on the other, you have a corporate structure that is bleeding cash while attempting a desperate pivot to an AI-first model. When you see that price of $7.15, you are not looking at a value play. You are looking at an options premium on whether this company can completely reinvent itself before its balance sheet implodes. Let's dissect the immediate price action. Friday's drop was not just a random fluctuation, it was a high-volume rejection of the $7.50 support level. For weeks, technical analysts, perhaps some of you watching on your Fidelity trading platform or checking charts on Interactive Brokers, have been eyeing that $7.50 level as a line in the sand. The bulls defended it vigorously throughout November, hoping that the new AI pivot narrative would catch fire. But on Friday, that floor gave way. When a stock loses a key technical and psychological level like that, it triggers a cascade of automated sell orders. Stop losses sitting just below the lows were triggered, flushing more supply onto the market. If you were using Robinhood stock trading apps, you probably saw the notification that Open was one of the top losers of the day. This creates a negative feedback loop. Momentum traders who were riding the brief rally in October have now flipped short, betting that the stock will retest its yearly lows near $5. The air pockets below $7 are dangerous because there is very little historical volume to arrest the fall until you get much, much lower. But the technical breakdown is just the symptom. The disease is the exclusion event. In late November 2025, Opendoor was removed from several key S&P indices, including the S&P Total Market Index. This is a catastrophic technical blow that flies under the radar of most retail investors. When a stock is kicked out of an index, it forces the massive passive ETFs, the Fidelity ETFs, the Vanguard funds, the Schwab Intelligent Portfolios that blindly track these indices to sell the stock. They have no choice. It is a forced liquidation. We are currently watching the tail end of that selling pressure. Millions of shares are being dumped onto the market, not because a human fund manager analyzed the balance sheet and decided to sell, but because a computer script at an index provider changed a line of code. This structural selling overrides any fundamental news. You could announce you found gold in the CEO's office, and the stock would still drop because these funds must exit. This is the invisible hand that crushed the stock on Friday. Now, we have to talk about the special warrants. This is where the story gets bizarre and arguably desperate. In a move that feels more like a crypto project than a NASDAQ-listed real estate firm, Opendoor recently distributed tradable warrants, Series K, Series A, and Series Z, to its shareholders. If you were an individual brokerage client, you might have seen these weird new tickers appear in your account and wondered what on earth they are. The expectation from management was likely that this would be seen as a reward for long-term holders, a sweetener to keep them engaged. The reality is that the market views this as financial engineering of the highest order. It confuses the capital structure. It adds complexity to an investment thesis that is already headache-inducing. Serious institutional investors, the ones who run Fidelity wealth management divisions, hate complexity. They want clean equity stories. By issuing these warrants, Opendoor has signaled that it is willing to use gimmicks to try and engineer shareholder value because the core business of buying and selling homes is currently broken. It smells like a distraction. It reminds seasoned traders of the late-stage maneuvers of companies that eventually went to zero. It forces us to ask, why do you need to issue complex warrant structures if your core business is supposedly about to turn the corner? Let's pivot to the AI narrative, because this is the rope the company is trying to climb out of the hole with. Under the new leadership of CEO Coz Najatian, who came from Shopify, the company is screaming from the rooftops that it is no longer just a house flipper, it is an AI platform. The pitch is that they are using advanced large language models and computer vision to automate the entire real estate transaction, drastically cutting the cost of acquiring and selling a home. They're launching tools that allow agents, formerly their sworn enemies, to use Opendoor's data rails to close deals. The expectation is that this will make Opendoor capital light. Instead of using their own balance sheet to buy billions of dollars of houses, they want to be the software layer that powers other people's transactions. It sounds great. It sounds like a tech company. The reality is that you can't just say AI and magically fix a gross margin problem. Building this technology costs a fortune. The recent earnings report showed that while they beat revenue estimates slightly, their losses widened. Why? Because they are spending aggressively on R&D to build these tools while their legacy portfolio of homes continues to bleed money. It's like trying to fix the engine of a plane while the plane is in a nosedive. You might build a better engine, but if you hit the ground first, it doesn't matter. This brings us to the macroeconomic buzzsaw. We are in late 2025. Mortgage rates are sticky at around 7%. The rate cut euphoria of early 2025 has faded as inflation proved more stubborn than the Federal Reserve anticipated. This is the worst possible environment for Opendoor. Their business model relies on velocity, buying a home and selling it 90 days later. In a high-rate environment, velocity dies. Homes sit on the market for 120, 150 days. Every day a home sits on Opendoor's balance sheet, it incurs holding costs, property taxes, insurance, maintenance, and the cost of the debt used to buy it. These holding costs are the silent killers of margin. The Q3 earnings report revealed that their contribution margin, the profit they make on each home after direct costs, is razor thin, hovering near 2%. That is not enough to cover their corporate overhead. If the housing market slows down even a fraction more this winter, that margin turns negative. They literally start paying people to take homes off their hands. This is why the stock is $7. The market is pricing in a scenario where Opendoor burns through its remaining cash cushion before the AI pivot starts generating meaningful revenue. I want to pause here and ask you a question. Comment below. Do you think the new special warrants, Series K, A, and Z, are a smart way to reward shareholders, or are they a desperate red flag? And how many shares of Open are you currently trapped in? I want to see the sentiment in the room. Let's look deeper into the agent partnership strategy. For years, Opendoor tried to disrupt agents, effectively saying, "You are obsolete." Now they are begging for their help. They have launched Opendoor for Agents, a portal where agents can get instant offers for their clients. This is a massive strategic 180. It admits that the direct-to-consumer dream hit a ceiling. People want agents. They want handholding. By pivoting to work with agents, Opendoor is trying to lower its customer acquisition costs. Marketing to individual homeowners is expensive. You have to buy TV ads, mailers, and digital spots. Marketing to agents is cheaper. You just need to convince a few brokers to use your platform. If this works, it could be the savior of the business model. It turns Opendoor into a B2B, business-to-business company, rather than a B2C, business-to-consumer company. But the execution risk is massive. Real estate agents have long memories. They remember Opendoor trying to put them out of business. Trust is low. Winning back that channel will take time that Opendoor's balance sheet might not have. If you are looking at investing sites or reading investment help forums, you will see a lot of debate about Opendoor's book value. Some bulls argue that the stock is trading below the